Welcome back, investor, to another episode of the Passive Income Adventures. We've got Charles Hamilton today in the house. Say hello, Charles.
Hey, how you doing?
Thanks so much for coming on. I'm really excited about our conversation today because you're working on a pretty cool development project right now. And we've done a couple developments, and I don't think we've ever talked about that on the show before. So today we're going to go over like your background, your history, like where you came from, how you ended up where you are. We can talk a lot about development, how we know how to vet development deals and just get the ability to be able to invest in those kind of deals, and then share with us a little bit more about your vision, your dream, and your hopes of the future. So, Charles, tell me a little bit more about yourself, like why you do what you do.
Okay. Well, you start with my background. I graduated from high school in Dayton, Ohio. So I'm a highway at heart, I gotta say. From there, I went to college at the University of Cincinnati and graduated with an aerospace engineering degree from there. And at the time, there were no aerospace engineering jobs, so I ended up working at a mechanical engineering company as a salesperson. Did that for probably about a year and a half, and then I went over to the hotline support area, and then ended up going to the implementation services part, which was probably the highlight of that experience. Because the one of the clients I got to work with, among others, was Xerox, which really helped me hone in on the process oriented side and also the project management side. From there, I went to Washington, DC with that company, decided to switch while I was there. And I ended up working with a couple different companies, but the largest one I worked was with Booz Allen Hamilton, doing consulting and project management on the software development side. So I did that for a while. And while I was there, I went graduated from joined the MBA program and graduated from my MBA program. But during the MBA program, my father passed away, and he left us a 4-unit mobile home park and a single family home that I had to manage. So I managed that for probably about the better part of 7 to 8 years or so before actually selling the land, and that was there. And I had some capital to deploy, so I was looking for investments. I looked at crypto, stocks, single family home investing, multifamily investing, and I did all of those. But the one I focused on is on the multifamily side. And just recently, which I get into later, got into the hotel side, particularly development as a whole.
Okay, that's quite a background. So I hear aerospace engineer and I immediately think to myself, like, dude, you're a rocket scientist, like a bona fide a rocket scientist. And it was kind of funny because I was having a conversation with somebody. She's also an aerospace engineer a couple of months back. And somebody came in and joined the conversation. They hadn't heard her say that. And we were talking about real estate investing. And he said something along the lines of like, real estate investing is not rocket science, right? And she's just nodding her head and she's like, yep, yep, it definitely is not rocket scientist. Take it from me. Like, I know, right? And I just sat back and I said, okay, do you need to feel like you're a rocket scientist to be able to go out and invest in real estate? Did you feel like with your background and your analytical background that going into these investments, did that background give you more confidence and bravery that like you could figure this out? Or did you feel like I'm an expert in this? Like what makes me think I can be an expert in something else? Like, can you walk me down that path, that thought process for you to get from an engineer to I'm a real estate investor?
Well, essentially, I would say it was definitely a benefit for me on the aerospace engineering side because obviously being analytical. But the one thing the program I went to did is it taught you how to think. And I still use those skills today. Just as an example, in one of the classes I was in, one of the aerospace engineering classes, physics, if I remember correctly, one of the questions on the exam was you had a snowball rolling down the hill. How long would it take for it to melt? Well, we hadn't gotten into any of that at all in the program. And what essentially happened was when we got our test back was that if you even tried to answer the question and came up with a plausible reason, you got credit for it. So that one experience taught me to think outside the box when tackling new problems and new issues. And
Oh,
as far
that's
as
a great
other
story.
as far as other things too as well, the program actually helped me understand how to do project management, and I'm pretty well organized from doing that. So I use those skills in real estate investment as well to keep myself on track, moving towards my goals.
It's really important for people to recognize like the skill set that they currently have can be altered and tweaked to fit the parameters of the new project. And I see most people who achieve some level of success, whether it's in one field like you did, and then into the second field, it's the ability to take what they learned over here and apply it to this new thing they've never seen before. That snowball question is a perfect example of that because you're being asked to sit back and think through this process and teaching those critical thinking skills. I think that's a lot of times I used to teach abroad, and one of the other professors said to me one time that the American school system was so much better than this European school system. And I said, I what? So all we hear about growing up is how terrible the American school system is and how far behind we are on math and science and all this. And he said, "Oh, no, 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 make no mistake." He said, "We will kick your butts on a standardized test. We know what year every war started, who fought it." He said, "We will kill you on that." He said, "But where you beat us is critical thinking and creativity." He said, "We just don't have any ways to teach that here." And that's where really the American school system, in his opinion, really shined. And that question that you just mentioned, if anything embodies that American entrepreneurial spirit, is what you just described there, but it was a physics question. So your ability to be able to take that physics question and apply it to your entrepreneurial journey, it, was that something that you already knew how to do before that, or was that something that question kind of made you sit back and think like, oh, I can do this with other things?
No, well, actually, when I was at Xerox, working for a company out of Ohio, it was really a mechanical engineering job, which is different than aerospace, but there's some overlap. I was working on a packaged software product. When I went to work in Washington, D.C. and switched over, I was doing ground up software development. So I had to use those skills that are on the project management side to switch over into something completely different than what I was doing from before. So I've always known that I can use the project management skills as being transferable to anything I went into to help me get to a task and to do it efficiently.
Anybody who was interested, my dad was a software engineer like back in the 70s, and he had a math degree, a math and physics degree. And he was able to take that and then go become a computer scientist before that was ever a degree. And we worked in data science startups for a while. My husband and I did both. And most of the people who were working there in those early days when data science, there was no data science degree before what, like, I don't even remember what year they started doing that. 2010 maybe was the first time I started seeing those around. So before that point, almost everybody working at that data science company who was a data scientist had some PhD in physics or something like that. And they were really taking that skill set that they learned and applying it to this new field the way my dad had to back in the, the early days of COBOL programming. And I don't know. I think that people who can successfully do that, that's a skill that you can cultivate, that you can be aware that's a thing and think to yourself, like, how can I use what I already know to go do this new thing? And I think that's a lot of the confidence that investors are often lacking. They're like, oh, I'm a business person, or I'm a high paid sales professional. I'm a rocket scientist. Like, I don't know what it takes to go out and be a real estate investor. And I guess the message that you're sharing right now is that you have a valuable skill set that if you repurpose it a little can take you to do new things that you want to do.
Absolutely.
Well, let me back up a little bit and tell me, what year did you sell that mobile home park? So how long ago was that?
2006.
Okay. So
Oh,
it's been
I'm
a
sorry.
number of
No, no.
years.
That's when my father passed away.
Okay.
It was 2018 or 19.
Okay. So you got your management legs under you with that project. Did you have any other real estate projects that you did at that time? Any single family homes, or was that the only one for the duration of when you owned that one?
That was the only one. Besides, I bought a piece of property from someone in the family, and did a promissory
Mhm.
note for that. But other than that, my experience came from the property that was managed for my father's estate.
Yeah. So kind of take me through that process of when you were doing your evaluations. Like, we sold this property, we made some money off of it, and your eyes were probably like, yeah, real estate, like that's where it's at. Right. And so your thought process of what you went through to say, okay, what am I going to do with this capital that I'm holding in my hand? When my dad passed away, my mom had already passed away. When he passed away, we inherited his house, the in Seattle. And so it obviously had appreciated a lot between the time that we were growing up in the house and when we finally sold it years later. And I just took that money and poured it right back into my real estate business because I already had the business at that point. And so
Mhm.
that basically that inheritance he had set aside for us to inherit, our childhood home allowed me to go and fund a couple of projects in my real estate business, but I was already down that path. And so when the inheritance came, it was like an obvious choice. Like, yeah, we're going to obviously, we made the money from real estate. We're going to go reinvest it in real estate. So tell me more about what that process looked like for you after you sold that property.
Well, essentially, what I was looking for is again one probably lucrative investment opportunities that with a low level of risk. Which if that really doesn't exist, but that's something that has
Yeah.
a minimal amount of risk with the lower barrier to entry. So I looked at, like, it's all looked at crypto, stocks, single family homes, and multifamily homes. But one thing I looked at was what would be allow a win-win relationship between me as the operator and the investors that I'd be working with. And I found the best way to do that would be multifamily. So the majority of the funds went to that, and the other funds went to crypto and stocks, and also, and right now looking for a hotel.
Okay. Now, I mean, I know all my siblings, we all inherited roughly the same amount of money from that home disposition that we did. And it's interesting to look at the different things that we all invested it in. I think every single one of us though invested it. And so it was fascinating to kind of see the different things that people were choosing to fit their lifestyle, their knowledge base, their level of comfort with either the risk or the investment class itself. And it's actually been really inspiring to watch all these different paths of the things that they chose to do. They even started a sibling investment club with them, which I wasn't invited to because I only invest. It's like I don't want to be in a stock investing club or learn about crypto or any of that. Just wasn't interested. So you sound like you're doing a little bit better job of diversifying than I am. I wanted to start in self storage units. We had a neighbor when we lived in Austin who developed Class A self storage units, climate controlled. And we were like, wow, that's the place to be. So that's where we started, but I just couldn't find a good deal. And then I had a multifamily during the course of looking for the self storage, a multifamily kind of fell in my lap that was a good deal. And so that's how we ended up in multifamily. It was almost like by default. But since we try to diversify pretty heavily inside of real estate, singles, small multis, large multis, storage, development, all of that. And a lot of my friends who were really into crypto during the time when it was going to the moon, they couldn't understand why I wasn't getting more involved in crypto. They're like, I make so much more money in crypto than I ever do in real estate. But then, as we know, like the bottom kind of fell out, and now they're coming back and being like, I need to get back into real estate. So how do you manage that? How do you reconcile when you see something that's mooning, and you're like, oh, I want to be in that, but maybe that because I mean, you do several different types of diversified investing. Like, how do you balance your portfolio to make sure you're taking advantage of opportunities, but not going too far onto the risky side of things, speculative.
Well, the thing is that what I do is, I make sure I work with experienced syndicators. So what I do is I look come on board as the asset manager on the deals that I'm getting into, and also raise capital for
Mm,
them as well. But the main thing that what I do is I look at the syndicators themselves, and one of the most important things I would say is make sure that you do your own underwriting and don't count on the syndicators writing. Make sure that you look at it yourself to make sure that you can back it up when you're dealing with investors. But those are the top 2 main things that I look at. The other parts, are we a fit with each other? Because with any syndication deal, usually you're looking at a 5-year term, and I'm hitching myself to this person's wagon for these 5 years. So I need to know that I'm working with it. I need to know that I can work with them. But that also goes with, and a lot of people miss that on the syndicate side, is can you keep a relationship with someone that you're investing with, or someone who's your investor, because you're going to be with them for 5 years too as well. So if they're asking, uh, if they're going overboard, or they're asking a lot of questions that are going to need to be answered, you have to kind of balance that with the relationship and how you're going to deal with that over the 5-year period.
mhm. The investors I think that you're describing right now, like got the nervous one who wants to ask a zillion and a half questions and is really looking for some education, but mostly reassurance that they have what it takes to be able to make an investing decision. So I want to talk about how you handle, that person who maybe asks a lot of questions but doesn't take any action, or they do take action and then they're nervous the whole time. And then the second one you described is you have to do your own underwriting. And for most people to be like, I don't know how to underwrite one of these deals. Like that's a pretty specialized skill. When I'm raising capital for a deal as like a partner, I make sure that we do our own underwriting. But as a passive investor, I mean, how much should a passive investor be expected to do their own underwriting, especially if they're the nervous kind who's like, I don't know, I'm going to ask a zillion questions. Is that at what level do you think the passive investor needs to be underwriting their own deals and finding their own answers and finding their own education?
Oh, they should be able to underwrite the deal if they can. If not, they can depend upon the syndicate to do that, but make sure they ask specific questions. And those specific questions, especially in the market today, are to make sure that the deal that they're getting into is underwritten conservatively. And you can ask questions specifically towards that to make sure that's happening. You can ask about how they came up with the interest rate that they're looking at in the future, given the current market, and how are they underwriting that on a conservative method too as well? On their capital expenditure bills, how are they underwriting that on that conservatively Do they have enough personal funds, if necessary, to put into the deal? Or do they have their own, they have a kitty, a war chest that they can draw from? And those are just a few of the things that I would look at as being an investor looking at a deal, regardless of where it is in commercial real estate.
Yeah, that's the skin in the game question. That's a huge one because I get that one a lot. Like, how much are you personally investing into this deal? And sometimes it's a lot, sometimes it's nothing. It really depends on how much capital I have to deploy. When I find a good deal, I I don't make the decision to invest in it whether or not I have my own liquid funds to be able to invest in that. Because if it's a good deal, we just need to take the opportunity. And sometimes all my capital is deployed. But what I do is I maintain a certain level of liquidity. So if I need to inject capital into that deal, we're going to do that as general partners before we ask limited partners. But a lot of times that skin in the game question comes up and the person is not investing any money and they don't maintain any liquidity. And so if anything goes wrong, like which partner is going to inject money into this thing? Who has liquidity? How much money is the general partnership putting in here? That's a huge, I don't think people ask that. I don't think I've ever been asked that. I usually try to offer that information, but I don't think anybody's ever asked me that first because deals, they need more money put in. Imagine you're a single family and the roof needs to be replaced. Like you're not going to be able to do that off of the couple $100 a month you're making off of the rents, right? You have to be setting money
Right.
aside out of the rents or have more of your own money to be able to do CapEx, right? So that's a huge one. I'm glad you brought that up. So if that, because something is always going to go wrong, they need to be
Right.
ready to put more money in. What are some other top ones that you wish people were asking? For me, big ones are, where did you get this insurance quote? Is this an
Especially if
official,
you're in
like, is there a
Florida.
binder paid? Like, is this your actual rate? Are you just guessing? Just, yeah, in Florida, my goodness. And then where did you get these property tax numbers? Is this from the
Right.
assessor's office? And did you call them or are you just guessing? Oh, it's going to go up about 10% a year. So those are my two big ones. What are other ones that you see that you're like people need to say this has been underwritten conservatively? What questions should they be asking? Some top ones.
To be straightforward with you, the two that you mentioned are the two that I would mention because those are the biggest hits to your net operating income on the expense side.
Yeah, those can tank a deal. But you know what else can take a deal? You mentioned it's like the loan, the interest rate on the refinance. That's very risky to be guessing that kind of stuff. So, how do you make your assumptions or your predictions about what you're going to refinance a deal at when it's a couple years out and there's no way you can get a term sheet for that right now?
Well, the thing is, I look at the interest rate and how much padding they put on it. I usually like to see a 1 to 2% bump on the interest rate based upon what they think. And even though the Fed is saying that they're going to be cutting rates, I still think that you should put in enough of a buffer on the interest rate just in case that doesn't happen. Because what they say is not necessarily what they're going to do.
Yeah. I think that the loan is 99% of deals that go wrong is because something's wrong with the capital stack, specifically the senior debt. And then maybe if there's some other layer of thing in there, like a second loan or some other things like that, like that's most of what goes wrong with a deal. But just being able to say like this, everybody says we underwrite conservatively, it's become a joke in the industry. So there are certain key points that we should be looking for to show a conservative underwriting. But I want to jump into what you're working on right now because you're doing a new development in Florida. Can you tell us some things that have been different about a development to ascertain if it has been underwritten conservatively? Some factors that you had to pay attention to that maybe don't exist on a building that already exists or a value add building.
Really, it's just specific general things that I look at. I look at the average daily rate assumption, and if I can get a CoStar report that shows what's going on in the market and what the what's going on with the market as far as cap rates on hotels, I can do that too as well. But really, it's just looking at the average daily rate and looking at the occupancy that's been forecasted and mapping that against other hotels in the area that have the similar uh, brand or similar level of brand, I should say, that's on it, whether it be a Hilton or a Marriott or something of that sort. And also, looking at one of the things that's different is on a hotel, you have what's called a PIP, a property improvement plan. And what happens when you're buying the
Hmm.
property is that a lot of times the brand will want you to do some CapEx expenditures to bring it up to their standards. And that's different than you have on the multifamily side. Nothing comparable to that on that side. And we were talking about before, that CapEx expenditure that's required by the brand can kill a deal very quickly.
Yeah. That's actually something because I don't do hotels, and so that's something I've never really thought about before. Because one of the owners of a mastermind I go to, he was doing a condo development that kind of was tanking in 2008, and they couldn't sell the condos. And so what they did is they converted it to a luxury hotel, and they couldn't get a hotel brand to pick them up
Wow.
because it was large condos, not small hotel rooms. And so they were really kind of panicking. What are we going to do? And so when they finally got picked up, the brand was not a luxury brand. And they're like, oh man, this reputation is going to kill us. And so he's telling us a story about trying to basically rehab this development that was going south and all of the hoops they had to jump through to make it successful. And I'd never really thought before about how important the brand was that's going to pick up the hotel. And when they finally did make some progress with this non-luxury brand, they went out and they got picked up by a luxury brand. And that really is when things started to take off. And I was like, I never really would have thought about that before. They do have requirements of what they need the building, the minimum requirements of what they need the building to be doing to represent that brand. Can you tell us a little bit more about that? Because it was not really something that was on my radar.
Which part about the brand did you want to know about?
Yeah, just like how the brand on your particular project has controlled some of the decisions that you've needed to make and the numbers that you've needed to verify that this brand would like pick you up or work with you.
Well, on this one, if I remember correctly, is I just joined the team probably about 3 months, but 2 or 3 months ago. Is that the
Hmm.
brand itself was chosen because it's a luxury brand. This is actually a boutique luxury project, and it's a hotel condos project with 120 units that are motels, a hotel, and 35 units that are condos. So,
Hmm.
but as far as working with the brand, we based upon where it's located, which is in downtown Sarasota, need to be a luxury brand because right around the corner from the Ritz Carlton and a Marriott that's close to it too as well. But as
Hmm.
far as that goes, I mean, definitely the brand is a primary concern when we're looking at a deal. If this was a deal that was to ground up construction, it would be probably more important to get the understanding of that and the PIP. You don't really have a PIP with a new hotel because it's being built to spec right away.
Mm-hmm. Okay. Yeah. So much there that makes it interesting as an investment. Can you tell me about how you got involved? And tell us a little bit more about the project itself and your entrance, your involvement with it.
Well, as far as what I'm doing now is the project had already flown out of the station, given that they're looking to break ground on the third quarter of 2020 this year, 2024. What
Hmm.
way I got involved with it was I saw the development and I said, well, one of the things I can do is help look for funding sources for it. And that would be both on the debt side and the equity side, specifically looking for it on the debt side by reaching out to different brokers that are out there for debt quotes, but also looking at family office and other institutional investors as well to to see if they're wanted to get involved with it too as well. So far, it's going pretty well. We have some interest from some family offices and also some institutional investors. So we'll see how that goes.
Can you talk to the listener a little bit about the difference between a retail investor, an institutional investor, and a family office?
Yeah, but I mean, the basic difference between the two is really the minimum check. One of the things is the minimum check they'll write. Mostly, if you're dealing with institutional or private equity of another sort or a family office, they're usually going to write a check at little amount as five million to get into a deal. The deal we're working on now is 120 million, and looks like that might come down a little bit because the construction codes are coming in a little less than that. But the main thing is just that.
Yeah, and I found that the word institutional can be a little bit confusing. And to me, it's like a business is going to be investing in this business rather than a pair of individuals. I mean, even if the married couple or the person creates an LLC to be able to invest through that, it's not necessary. But if they choose to go that route by creating some sort of an entity to be able to invest through. It's still not really an institution because there's no business. And that's why their check sizes are so much larger. It's like it takes a lot to underwrite these deals, as you described before. And the amount of effort that goes into saying, like, we're going to vet this out. Like, if we're going to do this, we need to write a really big check because we're gonna spend
Hey,
just as
worth your
much
time.
time underwriting, yeah, for $1 million as we would for $20 million. And so yeah, that's definitely been a thing. It's like they know if they're gonna back something. The other thing I've heard, even from a retail investor, he's like, "What's your minimum?" I'm like, $50,000. He's like, "How do I want to invest $50,000?" He's like, "What kind of a what kind of an incentive can you give me for putting in more, like 200? And I said, well, it's like the first time we work together, maybe we should kind of stick to the 50 and see how we get along. Like you said, for the next 5 years, you can always invest in another project in a couple of months when we have another project, right? And he goes, no, I don't like $50,000 investments. It's too much to keep track of. It's like, yeah, it's just like, oh, is this one paying out or not? And it's the time I spend. He's like, no, he goes, let's just do the incentive for the higher amount. And I was like, yeah, okay, you talked
Okay.
me into it, right? It's the same kind of thing. It's like keeping track of all of these investments is a pain, right? And so
Mhm.
the most you can invest comfortably rather than hyper diversifying and having lots of projects takes time to underwrite them, takes time to manage them. So an institutional investor or family office, which is like a wealthy family where they hire people to handle their portfolio, they just don't want all these little investments scattered around that they need to either underwrite or babysit. Yeah, but sometimes people think, "Oh, they're gonna come in and they're gonna want a lot of control," when you're writing a check that size. Have you noticed as you've been raising capital from retail versus institutional investors that there's any difference in the level of input or say that they want in the progress or the management of the actual deal itself?
And definitely, a lot of times the institutional family office wants to be on they want to be on the GP side, so they have a little bit more control. If they don't, then
Mhm.
there's going to be meetings with them over a period of time to make sure that everything's on track. Where you have similar meetings with your retail investors, but just the quality of information or the amount of information that you're going to provide is going to be completely different and packaged a little differently. So that's really where I
Mhm.
see being the difference between the two. And also
Mhm.
the
That's
which you mentioned before, the check size that comes in from a retail investor is a lot less normally than what you would get from a institutional family office.
the numbers heavy, and I'm like, "Oh, I gotta comb through this," right? You don't always so I'm not at work right now, and I still feel like I'm working because 'cause I'm managing that portfolio. So, ho do you package it a little bit differently depending on the audience?
We can feel comfortable that the deal is still on track. But like for instance, with the deal in Sarasota, Florida, there's a promote structure or a waterfall. And the first part of that is a 90-10 split, then a 70-30 split, and a 50-50 split on the equity based upon meeting
Mhm.
certain criteria. Specifically, our hurdles that they're looking for us to meet to get those amounts or those approach structures.
Okay, so that is a good point that you bring up because I've noticed on deals of ours that are targeted for retail investors, having a more complicated waterfall structure is often something where they're like, I don't know what I'm looking at here. And if you're confused and you don't understand the deal, oftentimes you're like, I'm just going to pass, right? But on the institutional side, they're used to looking at these super complicated structures that have multiple thresholds and waterfalls and district. We're going to split it 70-30, but if we hit this, then we're going to do a 50-50. So a simple waterfall structure, most retail investors really get that. In fact, we had problems with one we did. It was just a straight split. No fees, no waterfalls. It's a straight split. And again, one guy, he said, I'm an experienced investor. I've never seen this structure before. And he said, I just don't have time to dig in to figure out if this is actually a good deal or not because it looks different than my run of the mill, a garden variety deal that I do. And so he decided not to invest in it because he just didn't want to take the time to pick it apart of this different structure. So I've noticed a deal structure is very important to keep that fairly standardized. So people don't feel like, oh, I got to dig into this. Like nobody likes to do that. But on the institutional side, it can be much more complicated and someone's getting paid to look at that. So it's a
Right.
lot different. Have you noticed that to be the case as well?
Well, I haven't gotten to it yet because we'll get into that once we get an institutional investor. But my assumptions are that they're going to want to see something a little bit more detailed than what we would normally give to a retail investor, just because of the questions that they ask up front and how savvy they are on the structure of the deal to begin with.
What's the difference between a retail investor who's like, I want to work with you guys. I think you're doing great things. I don't quite understand all of these numbers because it can get really nitty gritty, especially the project the size you're talking about. How can they find confidence to be able to invest if they can't read or understand the detailed levels of reports that somebody who does this for a living is going to do? Like, where are they finding that comfort level to be able to make those decisions?
Well, one of the things is the simple things that we look at is the equity multiple of the project to determine how much money they're going to get based upon their injected capital at the end of the deal to look at that. But I think really it goes back to with every deal that you're dealing with is you have to have confidence in the syndicator that you're working with. Because if you don't have confidence with them, you don't want to put money with them. So I would say two things, experience and confidence experience of the syndicator and specifically the syndication team, not any one individual, but and also yeah, this syndicated team.
And how do they evaluate that experience? What kinds of things are they looking for to say, like, I trust this group to do what they say they're gonna do? Because I mean, we all were first timers at one point, and I was able to raise money for my very first deal because somebody said, I know you don't know what you're doing, is basically what he told me. I know you don't know what you're doing, but I like what you're building and I like your vision and I want to support that. And he was a large investor who was very experienced, and he threw us a little bit of money basically because he wanted to support what we were working on. That's a very different conversation now that we know what we're doing and we have a lot more experience. Nobody says, I just want to support you guys and throw you a little bit of money. So it's a very different conversation. So what, what are people looking for to evaluate whether or not they want to work with this indicator? In his case, it was like, I like your character, I like your vision, I like your program, but that's not normal. Like, what would be more typical to say, I trust this person?
One of the things that I kind of look for is more of a preference per se, is someone who's been doing it since 2008 and has experienced a downturn, because I want to know how they reacted to that downturn and exactly how they went about keeping their assets afloat during that period of time. Now, I'm not saying that I think the same
Mm,
thing's going to happen in 2024, 25, and 26, but the fact that they've already been through it and they have an idea of how to get around an event such as that, or if even if it wasn't that event, tell me about a deal that went south for you and what you did and how you compensated the investors during that period of time. Because again, I want to know what happened and if everything doesn't go right.
yeah. And having those war stories. I mean, I had a deal go bad during, I think it was in 2021. It wasn't a deal that we bought that went bad. It was a deal that we didn't buy until we lost our earnest money and some things like that. And it was a pretty tough situation, but we went through that when the market was doing well. And so basically I just told my earnest money partner, I'm like, I'll just pay you back. Like if the deal had gone well, he would have kept his money in and partnered up on it. But when it didn't go well, I'll just pay you back. He's like, "No, I'm a general partner. I don't need to get paid back. I knew the rules of the game when I started." And I'm like, "Well, we sold a property this year and we had a gain. And so I'm going to give you basically forward interest in that gain that I had on this deal. 'Cause I'm going to have to pay taxes on that capital gain. So I'd rather pay you." And he's like, "Okay, here are my wiring instructions." Right. So it's just those kinds of
Or death
experiences and those
twice.
kinds of stories. Yeah. It's like the fact that I had a deal that didn't go as planned is not that's not the important part of the story. The important part was how did we handle it and how did we come out of that? So, what kinds of signs are you looking for? Especially if somebody had a deal go bad. I had somebody tell me, he's like, I had a foreclosure in 2008, and every loan I ever get for the rest of my life, I have to talk to the lender about that. And I need to disclose for the rest of my career that I had a foreclosure in 2008. And I thought to myself, well, didn't everybody have a bad year in 2008? Isn't that kind of a pass? But, it's how he's recovering from it. So what are you looking for when they tell that story, like how they recovered from it? What are some positive signs that you see like, yeah, I can trust this guy?
One of the things that I want to know, and this might be hard since it's previous, is how they kept their investors in the loop about what was going on and what they were going to do, and how do they communicate that out to their investors? Because what I definitely don't want to deal with is someone who's going to not say anything and try to solve the problem themselves. That's just a non-starter for me. So I want to make sure that their communication is up to snuff, and where I get the hair standing up on the back of my head is when a syndicator only wants to present information to the investors once a year, because
Mm,
I don't care how good your track record is. I want to make sure that I'm communicating to my investors at a minimum once a quarter, but preferably
mhm,
once a month. Even
mhm.
if it's just a quick note that everything's going fine and what they're working on and what challenges they have. Just something.
Yeah. But most syndicators don't actually communicate. So before you invest, you have no idea if they're going to be good communicators or not. So are there any red flags that you're looking for before that point, before the money's actually placed, that this group can communicate well? Like what should an investor be asking for?
It's the same thing. It's just I want to make sure that they have additional funds available other than the funds that are in the project. So if something goes south, that they'll be able to take care of it, or at least they thought it through. That's the point I think they want to know. And the
Mhm.
other one is just reporting, because a lot can come out of the reporting, and you can ask questions and provide feedback to them to even help them out through the particular strain that they're going through at the time. But if they're not communicating any of that, and then you've been
Mhm.
spent a year, and then they're telling you that after a year's period of time that the deal's going south, that's again not a non-starter.
Yeah, I like to ask for some old emails. Like, show me some communication that you've had with people in a different deal. What does that look like? How often does it come? It really tells me something like, how are you communicating with your current investors? Again, nobody's asked me that. I just try to offer it.
Right.
Well, tell me a little bit more about the project that you're working on right now. Like, give me some of the sexy stats on what you're building. Because when I first saw it, I thought, well, this thing is beautiful, and your materials are very well done as well. Which, as a marketer, I always notice that kind of stuff. So, yeah, just tell us a little bit more about what you're working on.
Like I said, it's a 120 unit project with 35 condos. They range from anywhere from 1.8 million to, I think, roughly 3 million for the condos themselves, depending upon the size. The
Okay.
strategy going in is to sell the condos and then have that pay back the actual the construction loan before going into permanent financing. It's a substantial down payment that's coming from the actual condos that are there too as well. The
Hmm.
idea is to refinance finance after a year and a half to 2 years in the project, and to stay in it for probably 5 years, and then to sell it off at the end of 5 years. Looking at
Hmm.
potentially keeping it, that's still on the horizon, but not been decided yet. And we've also gotten quotes, I think for 150, 160 million once it's completed, and putting 100 to 120 into it.
Okay, that's a substantial amount of equity. How common is it to have a hotel project that includes condos? And is that becoming more of a thing, or is it kind of cutting edge as far as does a hotel chain want to pick it up if there are condo units in it, or are they in a different building, or how does that work?
Well, the actual condos are on the top floors, from I think
Hmm.
it's from the 12th or 11th, I can't remember, to the 16th floor. And the bottom portion of it is for hotels. So one of the benefits for the condo owners is that if they ever had want to have a party of some sort, there's a party room, a small party room, if I remember correctly. But they can also have the guests stay at
Hmm.
the hotel in the same space and location that they're in. One other thing too with this hotel, as far as barriers to entry, in Sarasota, there's only permits left to have hotels that are 16 stories high, and we've got one of them. So there's only one other left that can be that height or that size. So they won't have to worry about blocking views or anything like
Hmm.
that, depending upon where the next hotel is situated.
Yeah, it looks absolutely beautiful. And so, what advice can you give to an investor if it's their first time investing in a new development, like up to a retail investor who's like, I've never invested in a new development before. This is interesting. I'd like to do it, but I just still feel a little uneasy. Like, what is the best advice you can give to somebody in that position?
I would take some time and understand the market that you're in. So in the case of Sarasota, understanding what the job market looks like to see where the hotels can get business from, whether it be businesses or travel or tourism. Sarasota happens to be high on the tourism side, so you have to be comfortable with that. And I would say the other thing too, as well, that you need to look for is migration of people to certain areas. Sarasota hasn't had an influx of people migrating, which is a good, strong signal, not only for the multifamily market, but also for the hotel market too, as well. And also looking for new businesses that come in the area. Those are probably the two top things. And just like with retail, residential real estate, location, location, location. The Sarasota Hotel is located in downtown Florida, right where all the entertainment is and the restaurants are. It's right in that quarter that's growing. If I remember right,
Mhm.
this one also is part in an opportunity zone too, as well. So some tax benefits that go along with that.
Yeah, a luxury product in an opportunity zone. That is almost like not even a thing. That's pretty amazing. So opportunity zones are basically areas that have been designated to need some economic injection, some economic stimulus, areas of town they try to revitalize, but been around since when did those first, like 2017, 2018, when those started
Right.
becoming a thing? And so some of the areas it's been very successful. They've had those economic injections over the last few years. and they've been kind of coming along. And so sound like, I mean, we built a project in an opportunity zone one time that was not luxury, but it was pretty high up there because it was right off of downtown and it was an area of downtown that they were attempting to revitalize, and it totally worked because people were coming in doing new developments and all that. So it sounds maybe similar to what you're working on there.
The latest hotel project that's been put down there is a Ritz Carlton that's in the area too as well. So there's some or you people who
Nice.
are jumping on the bandwagon in that area too as well.
Is there anything else about this project that you want us to know that maybe I haven't asked about?
Not that I can think of. I think we pretty much covered it. But like I said, I'm a little bit biased. I think it's a great project in a superior location.
Yeah, I find that when I'm raising capital, I have better access to better deals because when I'm able to bring money in, people bring me deals, and I get to be a lot more picky about what I choose to take on and what I choose to raise capital for. Have you noticed that to be the case too when you got to the point where, because raising money is a whole different skill. When you got to that point where you're like, I can raise capital, were you able to be more choosy about the projects that you took on?
Yeah, for the most part. That's why right now I focus on getting a 2 hotels this year under the belt. That's a goal. But looking at
Mhm.
multifamily deals that have to be great deals for me to look at it because I don't want to take away my focus from the hotel side, from the hospitality side. So still a lot to pick up, but moving forward fast.
Yeah, I'm starting to pick up a lot of the hotel stuff too. I do a pitch deck design for Syndicators and picked up a couple of hotel acquisitions. And when he first asked me, like, "Oh, can you do some of our hotels?" And I was like, "I don't actually know."
Maybe.
So I've been learning a lot about hotels and hotel acquisition in the process of designing the marketing materials for this acquisition. So it's very similar to multifamily in a lot of ways, but there are definitely some extra considerations. And then when you put development on top of that, it definitely is not, it's not identical. There are different types of metrics and things that we need to be looking at. So that's why I'm really curious about, because not only are you doing a hospitality project, but it's a ground up. And so you're bringing in a lot of different things that I haven't spent a lot of time in hospitality at all. In fact, I tried a few Airbnbs and people would text me and they'd be like, "Hey, is there a blow dryer?" I'm like, "Yeah, Walmart. Why don't you go down there and get one?" Like, I'm not cut out for hospitality. Well, so take us into the future a little bit here, maybe 5 or 10 years. And where do you see yourself? What are you working towards? I know that you had a really rewarding engineering career. You're having a rewarding real estate investing career. Tell me about your plans over the next 5 to 10 years, and especially, like, as you get closer to, like, a retirement age eventually, like, what does that look like for you? Like, work people say, "I never wanna retire," right? But that means I don't ever wanna not have purpose or not have a project I'm working on. I don't wanna get bored. It's not so much like I wanna work my 9 to 5 till I'm 65. So can you take me through that process of your, I guess, your bucket list or your future plan and what that looks like? What gets you out of bed in the morning?
It gets me out of bed in the morning is I have a burning desire to be a catalyst for generational wealth for my family. So what I had done, I think it was last July, is we had a financial mastermind where I brought in a couple of family members and also friends of the family too as well to discuss investments and also trust, estate planning, investing in stocks, investing in multifamily and other different types of investments that they can get involved in. But that's my main goal. But as far as my 5 to 10 year plan, really aggressive. What I want to do is be at 1 billion in assets in 10 years, and that's not just on the hotel side. It's starting off with multifamily and hotels. My strategy is to go wide on the 3 areas: the hotel, multifamily, and buying businesses, and then go deep on those by bringing
Mhm,
in people to help work those areas with me to build. I guess we can look at it being a private equity firm. So that's kind of where it goes. And in addition to
mhm.
that, looking to buy other single family homes or condos or investment properties in the international markets, and also look at development in international markets after I get the development under my belt in the US.
Yeah. I have some people to introduce you to in that sector. People come to us every once in a while and they'll be like, "Hey, we've got an international, we're building a resort in Central America or Southeast Asia," something like that. And I'm like, we are not the fund. We are not the fund for you, right? So I've started networking with more hospitality funds so that I have some referrals to be able to say, go try this. It's, while we are a diversification fund, we diversify across like short and long term lending and equity. We are not doing that doesn't mean we're going to just do anything under the sun. We still have a
Right.
specialization. And so it sounds like what you're kind of aiming for, though, is well, first of all, it sounds like you're almost starting a family office for your own family, like your family bank and your family office, to be
Actually,
able to get those your assets built up to the point where you can have a group of core employees who manage those acquisitions of portfolio on behalf of you and your family, or with you and your family, which I don't know if a lot of our listeners are familiar with that concept. We talked about it a little bit, earlier in the program, but that this is a goal that you don't have to have like your own real estate that company that you're running. If you have a lot of assets, you bring them under an umbrella and make sure that those assets in that business continues on even after you're to the point where you're not actively at the helm, or even after you pass away. Can you tell us a little bit more about what that looks like in your case?
of this. So that way, because we getting back to the question you asked earlier, is I really don't. I'm not looking to retire, but I am looking for location freedom, and also not being having to be able to work 40 hours a week, 4 weeks a month. That's doesn't attract to me, but something where I can spend my time up front building it, and then what maintain and grow it with the team that I'm working with, and get down to maybe 10 hours a week would be beneficial.
Mhm.
But the main thing I want to do is start
Yeah.
something that my family will be able to take to benefit from, which, like you said, leans more towards a family office, but kind of a combination of that and private equity direction I'm going.
Yeah, I that's probably similar to what we're working on too, because I like you said, if I work less than 10 hours a week, I do kind of get depressed. I wonder like
Right.
what's my purpose? I'm not floating around. But if I work more than about 30, I start to feel like, what is the point of all this? And I feel like I have time location, I have freedom location because we are retired on our passive income, but at the same time we take on projects and sometimes it gets out of balance. And my kids are like, "You want to go shopping?" And I'm like, "Sure." And the whole time we're driving there, I'm on the phone. And
Right.
so having to balance that, because it's like, in a regular world, you wouldn't be homeschooled, you'd be in school, and I'd be working during these hours. So I just had to come up with a deal almost. It's like between the hours of 8 and 5, pretend I'm at work. And if I can slip away and do some fun things with you and I get a phone call in the middle of it, or we're going to go do this, but I have to take a meeting in the middle of it. It's like, you just got to be chill about it. Because I think working less, working part time, it just opens you up to these opportunities to be like, I'm here, but I'm not here. Like,
Right.
I'm at the family reunion, but I had to step out to take a phone call, and balancing that becomes really tricky. Have you found that to be happening as you're going more down this entrepreneurial route?
So it's put, like you said, just similar to what you said, it's put structure, a little more structure into my life. So from
Hmm.
10 to 12 and 10 to 12 a.m. and 6
Hmm.
to 8 p.m. is when I'll take calls from people wanting to inquire about investments, or to talk about investments, or to talk to me about anything. Is usually during those times. And then from 12 to 5, let's say, or 6, around that time is where I do most of my work. But like you said, what I do is,
Hmm.
one of the things, I take care of my mother. So she wants to go shopping, she's going shopping. So I take her shopping during the day, sometimes too as well.
Yeah.
Whenever I can find the balance to be in favor of me, allowing me to do that. But far as I know right now, just like today, not today, but yesterday, Wednesday afternoons are her time.
Yeah. I was really running into that problem so much because my sister-in-law would say, be like, let's go shopping. And I'd be on the phone the whole time. She's like, "You're on the phone all the time." And I thought, I don't really feel like I'm on that phone the whole that time. It's just, it seems like every time we hang out, that's been happening. And so I really had to sit back and think, like, what exactly am I doing here? Just like
Right.
reevaluate. It's so nice to have that freedom to reevaluate. Like, tell me about the pace of life that you're looking for, like that 10 to 20 hour work week. What are you going to do with the other hours? What are your big plans?
Well, mainly is, hopefully use that time to help others get to where I've gotten, is to spend the time doing that, because that again doesn't seem like work to me. But as far as getting
Mhm.
in, working in deals actively myself, I'm looking to set up a company that'll grow without me, because I want to make sure that generational wealth is there. And if I'm the one who's always running it, then I have the difficulty of finding somebody who can step in and do the same job that I'm doing. Whereas I want to do that up front and make sure that my time is minimal in the deal, and preferably zero if it came down to it. If I can get away for 2 months and not have to call in the office and everything's still the same when I get back, that's the goal. because when I'm not here, it's going to be
Yeah.
a much longer time for them. And I'm in the process of
Yeah.
setting up the structures to do that now.
So interesting. I think it's the merry-go-round analogy. I bring it up a lot on the show. It's like you have your kid on a merry-go-round and you're pushing it a lot to get it going. But then after a while, they're just going around. The kids are streaking with fun. And as long as you don't overdo it, right? And I can turn
Right.
around and I can talk to my husband or I can talk to some of the other parents at the park. But every once in a while, I got to turn around and push the merry-go-round a little bit because it's slowing down or a
Right.
kid needs to get off or whatever. But it's not something that you can just push and leave it. There's no such thing as perpetual motion. I've talked to a physicist here, but thinking in terms of it takes input and it takes maintenance, but I don't have to stand there pushing it the entire time. It does get some of its own momentum. And that's really what sounds like what you're shooting for.
Exactly.
Well, thank you so much for coming on the show. I really appreciate this opportunity to get to know you a little bit better. I know we've known each other on LinkedIn for like a couple of years now, I want to
Yeah.
say, but this is the first time we've been able to sit down and have like a long conversation. Yeah. And talk about what you're working on and your background, so interesting. And some of the things you're working on. It's like, it really helps people see like, this is a possibility for me, like building the dream, especially with your career. It would have been very easy for you to just, because it's a prestigious it's a prestigious type of area or career to be in. And so it'd be really easy for you to just kind of rest on that and be like, this is my identity. But the fact that you've been smart about it and you diversified your skills, diversified your money, and just thought a little bit more long term about what's going to happen to your family and all that. I think it's just really inspiring for our listeners who really identify, with people like you. So appreciate you sharing that story.
No problem. Anytime.
Well, be sure to reach out to Charles after the show. Charles, how do people get in touch with you? And I always ask the question, why should people get in touch with you after the show?
If you're looking to understand a little bit more about hotels and our apartments and looking to get some pointers, I'm definitely here for that. But the way to reach me is directly through my email, which is Charles Hamilton at Hamilton Investments with an S, grp.com.
Awesome. So Charles Hamilton at hamiltoninvestmentsgrp.com.
Mm-hmm.
Awesome. So I appreciate everybody here listening. The purpose of these shows is to network. I mean, on the one hand, I get to be selfish and ask you all the questions that I want to ask you, for my own personal enrichment. But the reason we record it and share it is because we want to network with you after the show. So reach out to Charles. Be sure to reach out to us at partnerwithrise.com if you want to have a further conversation about what we're working on and if this is something that is going to be a good fit for you. And if you want to come to our weekly meetup, and it's at riseclubcapital.com, where we just get out these deals, we break them open, nitty gritty, and we analyze them together. So if all these questions, the underwriting questions, like how do I know if it's underwritten conservatively? How do I know if the operator's trustworthy? Like this is what we do every single Monday night is crack open deals and look at them together. So it's kind of like having a team of people who can kind of keep us on track and notice things that we didn't notice. And we would love to see you at our weekly club meeting, riseclubcapital.com, and also to partner with Rice to jump on a phone call with us. So thanks so much, Charles. And until next time, I wish you the best luck on your new project.
Good. Thanks a lot for having me.
Until next time.